By the way, speaking of preserving animal spirits, my next guest, getting a ton of press on this one, he says that the market could be propelled much higher. Try 10,000 on the S&P by the end of the decade. I want to bring in now Yardeni Research President, Ed Yardeni. So, Ed, let's talk about those animal spirits. Explain them to the audience.
Sure. Well, look, John Maynard Keynes came up with a phrase many decades ago, and the basic idea is spontaneous optimism. And I think that's what we saw when the election results came in. I think, first and foremost, it was a great relief rally that we actually had the results and there wasn't going to be a contested election. And then once that was clear, I think everybody kind of scrambled to see what the policy implications of Trump 2.0 might be. And the stock market clearly latched onto the accentuated the positives, which is, of course, tax cuts, deregulation, and even possibly some resolution of the geopolitical crises that are out there under Trump 2.0. Meanwhile, the bond market focused on the potential inflationary implications of tariffs and larger deficits.
Right.
So, look, it's not a clean cut. It's not a clean sweep on policies, but it is a clean sweep on the election.
Right. And you point that out in your note, corporate tax cuts, deregulation. Also, and you talk about this a lot, faster productivity gains. Another thing that's really interesting to me, looking at your note, looking for the next couple of years, you're looking at margins actually getting better. So 13.9%, then 14.9%, earnings profits, 275, 308. What kind of multiple are you putting on these?
Well, I've kind of concluded, and maybe this is a jinx, but I've concluded that maybe these multiples are appropriate if there's not going to be a recession for the rest of the decade. Look, I'm not telling you there'll never be a recession again, but we just had a terrible recession over the past 3 years that didn't happen. It was the Godot recession. It never showed up. And this was with the Fed going from 0 to 525 basis points. If that couldn't cause a recession, and by the way, we didn't think it would, then what's going to do it over the rest of the decade? And the longer you can look out without a recession, the higher the multiple you're going to be willing to pay, because the companies will grow their way to a lower multiple.
Right. So, of course, everyone's talking about the end 2029. We're going to end at 10,000. This is a stair step on how we get there. Is it really as big of a deal as it sounds to be at 10,000 by 2029?
Not really. I mean, you don't have to make crazy optimistic assumptions. The only one really is valuation, that the valuation multiple doesn't take a down. The Goldman Sachs folks are saying that over the next 10 years, we're only going to get 3% per year, and that's total return. And I disagree with that. I think the multiple is going to stay high. And I think the other surprise is going to be earnings are going to be robust, because productivity, I think, has already demonstrated that it's making a comeback and will continue to do so.
So before I let you go, are there any potential dark clouds, anything that might upset this right now? Or somewhere over the next couple of years? That would be unusual. That would be like man bites dog. I mean, we'd have to interrupt programming for the whole day if you're wrong, Ed.
No. I'm due. I had three great years forecasting.
I don't know.
And I'm due to be wrong here, so I could be wrong. And if inflation suddenly makes a comeback and the Fed realizes they're going the wrong way, instead of cutting, we should be raising rates, that would be a problem.
Last time I remember you being wrong was Y2K, and that was a long time ago, my man. So.
That's a long time ago. Thanks for remembering my one big one.
You're one big one, but I tell you what, you more than made up for it since then. In fact, our viewers love you, man. Thanks so much, Ed. Appreciate it. All right, folks. The great Ed Yardeni.